you everyone for attending us. I was curious to see with capital raising in the other room how many people we get. But so I assume these are all the CFOs of the well capitalized companies at the event. So it's great to see so many people in here who have plenty of capital. So thanks, Peter. My name is, like you said, Craig Hiltz. I'm a partner at Wilmer Hale here in Boston. I have a legal practice specializing in corporate finance and capital raising transactions, but frequently work with CFOs to give them the legal advice and raising the money that they need. So I'm going to go ahead and briefly introduce the panel here, and then I'm going to give each of them an opportunity to tell you about themselves, the organizations they work for, and give a sense of the teams that they manage, so that we can have a better context for how they work with other teams. So just going in order here, first is Loretta Keene. Loretta is the CFO of Arcadia IO. Next is David Forlizzi. He is the CFO of Vericode. Next is Brett Fye, who is the former CFO of a company called Lumion. He just took a new job being a CEO of a company, but he has been his whole life a CFO. And last is Greg Hansen, who is the CFO of Global Partners. And Greg is our public company representative on the panel today. So first, I'm going to go in alphabetical order here. I'm going to turn it over to Brett to introduce yourself and talk a little bit about, I think we can focus on Lumion, given that that's your most recent CFO experience.
Well, good morning. I appreciate being here today. I mean, you asked to be on the panel, Peter, wherever you just disappeared. There you are, hiding in the corner. So thanks, and appreciate being here today. I actually am not going to focus on Lumion. I've been a CFO of 3 different companies in my career. Now, you just say joining a company as a CEO in the software industry. Lumion was a smaller venture capital-backed company with just a couple of people in the finance team. Some of my questions later that I'll get into some of the more specifics, probably most relevant before that, I was at a company called Press Ganey, which was in the analytics, insights, and consulting business at about $500 million in revenue. Had been private almost its entire history when I joined and just gone public. The finance team there was about 35 people. We had 8 in general corporate accounting, which included the payables, payroll. We had 20 people in billing and collections, and then we stood up an FP&A team that didn't exist before I got there of about 5. So about 35 in total for the company.
Okay, great. Thanks, Brett. David, turn it over to you.
Yeah, so good morning, everybody. I'm David Forlizzi. I'm the CFO of Vericode, which is a Boston-based technology SaaS is a software service based company. We basically we're about $300 million in revenues. We have a tool that basically software developers use to scan their tools to look for vulnerabilities that hackers can exploit. In my role, a bit is from the Crossfit side, I have the traditional responsibilities as being in charge of FP&A and accounting, but there's also the IT, the internal IT department that rolls up to me, as well as the corporate development team, and uniquely enough, sales operations also rolls up to me within the CFO organization.
Okay, great. Thanks, David. Greg.
Thanks, Greg. Glad to be here. Good to see everybody. My name is Greg Hansen. I'm the CFO of Global Partners. We're a Fortune 500 publicly traded master limited partnership. We do about $18 billion in revenues per year. It's a little misleading though, because we're a commodities company, so our EBITDA is more around 400 to 500 million in EBITDA. But we're one of the largest regions. This region's convenience store and gas station business. We've got about 1,700 gas stations from Maine down to North Carolina, and then we're one of the largest wholesalers in the Northeast. We have about 10 million barrels of storage throughout the Northeast that we sell, both refined product and renewable fuels through into the Northeast market. And so my team is, we do have a chief accounting officer who reports to me. He handles all of our internal controls and our tax and our accounting functions. Then we have a treasury team that does all our capital markets raising as a public company. We also have public bonds and a lot of bank debt too, so they handle that and the day-to-day cash management needs of the company. We have a risk team that does all our commodity hedging. We're about 300,000 barrels of different products we're buying every day in the marketplace, so we hedge all of our products. So we have an extensive team that works on our risk of hedging of all of our products, make sure we're balancing our book correctly and placing our hedges correctly in the market. Then we have a credit team. We sell to a lot of commercial customers, so we have an extensive credit team. We do extend credit to commercial customers and need to focus on that on a day-to-day basis. Then we have FP&A teams that report to me both on our wholesale business and our retail business. And then we've got an SEC reporting function. That's obviously of a large focus right now, especially with all the moves the SEC is doing on ESG and cybersecurity. It's a big focus for us right now, making sure we get things right with the SEC and remain in compliance. And then the insurance group rolls up to me too, which being in a fossil fuel company, there's a lot of pollution liability insurance that we're constantly looking at. So very important too.
Okay. Thank you, Greg. And lastly, Loretta.
Morning, everybody. I'm Loretta Keene, also delighted to be here. Arcadia.io is a healthcare data analytics platform working to work with our provider and payer and life science customers as they're improving healthcare for patients. Our stage of business is we're on the growth side. We're financial sponsor backed, growth equity. We can see 100 million. After talking about 18 billion, I'm going to round up. I can see it. We're not there, but it's coming soon. From a team perspective, we're pretty efficient on the finance team. We've got reporting into me. I've got FP&A and accounting, legal, payroll, and risk management. I'll focus on the accounting and finance side. There are 8 members of that team.
Great, thank you. So what I want to do first is kind of to dig into some real world examples so we can talk about, give each of you an opportunity to talk about a specific topic, where you work with other teams in your organizations, with the goal of adding value to the business overall. So Brett, I'm going to start with you. Your company does a lot with data analytics. It works a lot with healthcare IT, which, and I'm sure is a lot of information that you guys end up managing. And I know you work with cloud hosting services in order to accomplish that. So curious about how you work with your R&D teams and who would probably like to spend lots of money in order to make sure that they always kind of deliver the value that they're doing for the customers. But I'm sure the cost containment is a major part of your job there. So how do you work with them to enable them to kind of deliver all of the services that they need to do without spending all of your money doing so?
A truer statement's never been said. R&D does like to spend money, and they're really good at doing that. Our focus has been, until the last 18 months or so, all about scaling and growing, and we invest a substantial amount in our platform. Our customers are some of the largest academic medical companies in the centers in the country. I'd tick off the Boston ones, but folks are familiar with that. Think of Cleveland Clinic, think of UT Southwest, Intermountain, really large systems. Health plans as well. Cigna is a customer as newly moving into life science market. And we are aggregating millions and millions of data points from them to help them improve population health management decisions, which are not time sensitive, and some decisions that are at the point of clinical care, which are highly time sensitive. And so when our teams were building the platform, it was all about responsiveness. And costs were not top of mind. And so we built one of the best in class systems. And what we found, and we have a great cloud partner, but what we found was our cloud hosting costs were, after personnel, and we're a SaaS company primarily, a close second. And that was not sustainable. And as we're moving to growth stage and leaning more into path to profitability, that became a key focus. And across the business, this isn't unique to finance. It's actually kind of a cultural thing for the business. We have business partnerships. And so a member of the finance team actually partnered with a cross-functional team, and this goes to the CrossFit, on a key business goal. How do we drive down our cloud hosting costs as a percentage of revenue, because we're growing, without compromising what we needed to deliver to our customers. And it was a functional team that included a member of the finance team, the director of our FP&A, engineering, product. We actually had someone as the cost optimization cloud guru. That was their principal focus. And they identified about a dozen different work streams that would take place over the year, and the year's now 2022. And they had weekly stand-ups, every other week meetings to track progress. And what happened was a member of the finance team he's not an engineer, but he's highly technical and got smarter and smarter about the challenges, because if this were easy, it would have been done. And no path is linear, and there were twists and turns on the journey. And I have good news to say that we're on track against our goals, and that's bringing our costs down by 1/3 as a percentage of revenue. And the focus and the partnership that's come from having finance at the table as part of not just project management, but as a true partner, and keeping that as a focus at the senior leadership level and at the team level has been one of the keys for success.
Great. Thank you very much. Very interesting. Next question is going to go to Greg. So in your business, looking through your public company reports, which I was able to find out a lot about, that guys, fortunately, with the public companies, it looks like you guys are pretty active in the acquisition and disposition market, and looking to acquire assets pretty frequently to expand your business. So curious, when someone within the organization kind of identifies a potential acquisition opportunity, what happens when they come to you and say, we want to buy this, or we're thinking about buying this? How do you work with them to either decide whether that's an attractive opportunity, and if so, to actually execute on the acquisition?
Sure. Yeah. So just to give you a little background on our acquisitions, we've been focused a lot on the retail and convenience store space the last 5 years. I think over the last 10 years, we've done about $2.9 billion in acquisitions. The retail convenience store space is a consolidating space. It's highly fragmented. About 60% of all the gas stations you see in convenience stores are still owned by a single owner operator. So there's still a highly fragmented market. That market is quickly consolidating, will continue to consolidate, especially if refined product demand declines with more EV adoption, or what the food is what's really interesting to us, and the real estate is what's really interesting to us. But we also think there's a long transition for refined products too over the next 10, 20 years. I think when acquisitions come in the door, it used to be us going out and finding acquisitions a lot. Unfortunately, that market's been brokerized and investment bankerized. So most of the deals we see now are not negotiated transactions. They're coming in from a broker or an investment banker. So they know we're in the market. They come out to us. I mean, our first quick screens with some of our ops people are, where's the geography? What does the site look like? Who is the competition there? We have a specific geographies we're trying to expand into, and specific geographies we won't go into. We'll never say never, but a state like Florida is extremely competitive. It's a high growth state, but it's extremely competitive with every competitor there. And we don't have a lot of interest in playing there. We just don't have synergies or a strategy to make it work. So for anything to get past sort of the door, it has to have synergies, has to work from a geography standpoint, have to make sense. And then what we found, we used to have an M&A team that basically ran with the deal almost all the way through the final bid. What we've sort of found is the problem was that M&A deal would run with the deal all the way to the bid, but really wouldn't go to the business, wouldn't be talking to tax, wouldn't be talking to accounting, wouldn't be talking to risk. And they somewhat get deal fever, honestly. And they would want to do a deal, they'd get very embedded in the deal. And it would be tough to change directions because you're so late in the game on a deal like that. And so what we've done is we've taken more of a project management approach. So we've got a PMO office inside of our organization that does M&A, but also does all the other things we're working on, be it organic CapEx or software projects or things like that. But on the M&A side, we really wanted to have an impartial sort of group that took all the deal information and went to all the different segments of our business and had them own. Accounting had to own accounting, and tax had to own tax, business operations had to own the ops of it. Our fuel supply people, our merchandising people had to own that piece. And so what we've done is we've sort of spread it out amongst the organization. We don't have a central M&A team right now, which is good in that everyone has skin in the game now on an acquisition, and you get their opinion up front. And so what we found is when acquisitions don't work, it's when people aren't interested in the deal or embedded in the deal or don't have skin in the game. So we really make sure to do a deal, everyone has skin in the game. Everyone has a KPI related to that deal once we get it. and integrate it. If you don't have that, those are the kind of deals that don't go anywhere for us. So we have the project management team run it. I mean, the one issue we run into it is we do have limitation on bandwidth because these people have other jobs. Our merchandising group is merchandising our 1,700 stores. Our supply guys are supplying all our terminals. So they're doing it in addition to their job. So it does limit our bandwidth to look at a lot of things at once. But what we found is the deals that we do, we're more successful in because everyone has voiced their opinion up front and has a KPI related to that deal and is more involved in it. So that's really where we've evolved to. We probably miss some deals, honestly, because we don't have the bandwidth to do everything. But I think in the long run, you want to do better deals and not many deals. So that's sort of how we've organized around it.
Okay, great. Thank you very much. Dave, next question is for you. So you mentioned that you work with your sales team closely, who I assume are all kind of financially motivated to go out and make as many sales as they possibly can. So curious, how you work with them such that, they're selling things in a profitable manner and a sustainable manner. So how you work with them to kind of develop, a product development pipeline, and then kind of based upon the work that they do, how you kind of take that information from what they're selling and forecast it into your future.
Yeah, so this is probably the major topic that kind of really got me personally into tech. It's a really fun part of tech where it's the type of deal that gets structured and what gets written in those contracts deeply impacts how you record the transactions, how you can process the transaction, and sometimes even understand what was sold. So deal structuring is a way where we have a deal desk, and that deal desk very often is working hand in hand with a lot of the different sales folks on special items or special requests or complex requests that may come from a customer. And as we get into those deals, very often, especially for even myself, I'm even alongside the deal desk on larger deals. You have the structure side, but then you also can play the sparring partner of, hey, well, I buy a bunch of technology as well, so this is what I would say if I was on the other side, and helping to coach the sales team and kind of understanding what procurement games could be getting played against us as from the other side of the customer side. So deal structuring has always been a fun part. Also, because I have IT within our group as well, I've had the ability to even influence how our CRM is used. So we use Salesforce. We've configured quotation tools in order to streamline the process of how we structure deals, how we flag deals for approval, and so that's been another fun part of the role as well. I guess the toughest part in the role is that you have to be careful. Well, I have to be careful very often that it's not Big Brother that's watching, because that's sometimes the way that we interact with some of the other teams is that we're there to stop their deals, we're there to kill their deals, which if trying to work the best with them and showing them that they're the quarterback behind the deal, because they're the ones speaking with the customer and they're the ones on the front line. It's just trying to show there's that trust, but yet we want to make sure that when that piece of paper comes in at the end of the day, we can celebrate it and not say we got to change something or there needs to be something that needs to be amended. The other aspect is on the forecasting and pipeline management side, which is, I'll say, fairly unique in some technology companies, because a lot of times this aspect tends to roll up more so towards a CRO, and here again that is our ultimate customer, and we are working with the sales leadership team. But there's always a beauty of art and science, they always say, when it comes to forecasting and managing a pipeline. And where we, from the sales ops side or from the finance side, can help influence is the science side of things, which is trying to structure the way that they're looking at deal progression, not just a feeling. But the feeling's important. It's not to say we shouldn't talk about that, but it's trying to give structure to those stages. It's also trying to use the science. The movie I'm always referencing is Moneyball. It's, if you can use it to predict what players are going to be the best at bat, then you can by looking at the past, we can also see what salespeople have sold within certain timeframes, within certain behaviors. And there's even a lot of great tools that are on the market that have a lot of AI that can kind of start to predict some of this stuff if it's well used as well. So that, getting sales leadership comfortable using that piece to add to science, not overwrite the art, but to be able to give them another data point is another area that we find working together. So I guess to sum it up, I would say is that trying to use data and trying to use more so a process and structure is where our forte is, and kind of trying to not overbear on the other side, but trying to be complementary as to the skills they have and the skills we can bring as well.
Thank you very much. And now turning to Brett, so one of the things that came up in one of the earlier sessions was, for any organization, almost people are the most important asset that everyone has. In keeping employees engaged, it's been a big theme throughout the news over the course of this year. So curious, how you kind of work with your HR team, to measure employee engagement, and what the finance organization role is, in order to address any issues that kind of come out of those measurements.
Quick show of hands, and it won't be a squat. So just quick show of hands. Who has had, after you've been to a hospital or a physician group, gotten a survey in the mail or through electronic as to your experience? So Press-Ganey, that was their 2 Notre Dame professors 35 years ago, innovated patient experience measurement. So 70% of the hospitals in America are Press-Ganey clients. So likely every hand that went up in this room has gotten a survey from Press-Ganey. One of their new verticals when I was there for the 5 years was employee engagement, measuring what was the workforce engagement in these large health systems. And our CEO made us eat our cooking, in the sense that we used our employee engagement tool in our organization every year, same time, no matter what, even if we've done a big merger or something, that there's some sort of stress on the organization, because he felt it was important to have your finger on the pulse. And then we had normal pulse surveys throughout the year. But my second year at Press-Ganey, we got the engagement survey results, and the surveys were structured that you scored about what people thought of the mission, vision, values, and how the company worked as a team. There were questions about how did your team, the finance team, work as a team, and then how did your manager do, and then there were sections on free-form comments. And if you looked at the scores for the company as in working as a team and communication, all 5 years, it was always one of the tough places, was that communication, interdepartmental relationships. My second year there, I got the results back, and you see that. And then I met with the 35 people in finance, and I said, there's a comment here written down in the free form about expired contracts are killing us. And I said, I don't know who wrote that. Don't want to put you on the spot, but can someone elaborate what that means? And so the person that included that comment said, well, here's what it means. So we had 4,000 clients, but about 8,000 invoices went out a month. Those typically went out on day 3, and we had revenue on day 4. And the clients typically signed 3-year deals. So you had about 2,700 contracts renewing every year. And when a contract, if the client's intending to renew the contract, but it doesn't get done by the expiration date, all the systems in the company were set up to shut off the services. So you would have this scramble at the end of the month within the billing team to reconfigure all the hospitals in a large health system on the products, reconfigure what products they purchase, so then we could send out the invoices. And so the question was, well, how many expired contracts do we have? Because this is not something that I've been informed of, and it's 30 typically. 30 out of 8,000. That's not too bad, although it consumes basically one person's full time at the end of the month every month. So you pick up the phone, and I ask the general counsel, hey, Devin, do you know that we have about 30 expired contracts and it's killing the billing team? And he's like, thought we cleaned that up. So, he conferences in the head of the contracts group, which is a dozen people that manage all those contract renewals. And of course, she says, yep, I know we have these expired contracts. Okay, so how did that happen? So you get into the story. So then you plug in the head of sales, and the head of sales, he's even more further away from the situation, in the sense that now his blood's boiling. How did we get to a point where there's a client out of contract, and how did we get 30 of them out of contract? So it then get all those people together to say, how are we going to solve this problem? It's one thing to clean up all the 30 that we currently have. How do we get in front of it so that we don't get to the end of the month every month and have new ones coming in that are expiring? So I committed to the head of sales, if we could ever get to 0 and he was based in Minnesota and us being in Boston, that I'd send him a box of live lobsters. So we always had that as a joke, that if you could get to 0, you'll get a box of live lobsters for you and your family. But Prescaney, with the volume that we had a deal review committee as well. So you talk about sales ops, that if you had any contracts that were outside of certain parameters, was there not an annual escalator? Was the price below this? What's the termination clauses? If there were anything that was outside of certain parameters, it had to come to the deal review committee. And that was myself, the COO, the head of sales, the head of contracts, and the general counsel. And the salesperson would have to present their deal and why they wanted it or why they thought it should be it could be outside of parameters. And eventually that committee became more of a coaching session to help people structure deals. But we just then added into that existing structure is then a report every month as to what are the contracts coming down the turnpike that we're having struggles with renewing so that we can get to 0. And while I was there, we never got to 0, but we got it down to 2 or 3 a month, which made life a lot easier, a lot better within the billing team. But it also, just got everybody very much engaged in those clients that were struggling renewing.
Was that good enough to get a box of live
No.
lobsters?
No. You'll hear in a minute. We had a CEO at Prescaney. I love him to death. I mean, he was. I'm from Indianapolis, and so I'm still a Colts fan, and it's been tough living here in Boston. But I'd say he was the Bill Belichick of CEOs. He expected people to play their positions well, and you had to play them perfectly. So no, I never gave him a box, but he still talks to me. He never
Okay,
got
that's
his
good.
lobster,
That's
but
good.
He still
That's
talks
good.
to me.
So my next question, it kind of picks up on the CEO point. So part of the teams, the cross-functional teams working with people that might be below you on the org chart and reporting up, but probably one of the more important teams you work on is an executive team, and thinking about kind of big picture, corporate strategy, business priorities, capital raising transactions. So I'm going to pose this to Loretta and then Brett, and I'm curious to get your perspective from switching from a CFO to a CEO as well. But just how do you partner with your CEO, and kind of what are your best practices, recommendations, or key takeaways for being a successful partner to your CEO?
It's probably the most critical in 1A, 1B of all of the partnerships. And I think the most important thing, maybe 2 things to remember, or I try and remember. I've got to bring my authentic self to the partnership, and the table stakes of what a good CFO should bring, whether that's technically and as a business partner, understanding the business. And then from there, it really is adapting to support the CEO based on the stage of the business, and the ambition and goals of the business, and the experience of the CEO. At my current company, very recently, a long-serving CEO planned a transition. This has been going on for a little while, but only recently became public, where he was stepping out of an operating role and into board chair. And the COO, who had been groomed, was recently named CEO. So in the partnership with a very experienced CEO, that required a different set of skills. I'm now working with a CEO who's absolutely brilliant on strategy, knows the business inside out. He grew up in the business, was chief growth officer before he was COO, understands the customers, understands the market. The important footnote here is he's in his mid-30s and is a first-time CEO and is 2 weeks under his belt. And so it requires, it's not one size fits all. He brings all of the strengths that I mentioned, and is looking to do a couple of things. One, get back to basics within our organization, and have the broader leadership team and the leaders and the bench of leaders that we're developing more involved in understanding the strategy and the roles and the importance of executing against that, and then the financial strategy to underpin that. So that's actually been something we've been working on in anticipation of this change. The focus has been on kind of three things. Board, so he's CEO, now a member of the board. Internal and capital raises, so those are kind of the three broad categories we're focusing on. From a board perspective, we're working to finalize our strategic plan, including our 23 budget. He grew up in sales. He's an optimist. You have to be if you lead sales. And that's the plan he wanted to take to the board. And my advice has been better to disappoint once when we're bringing the plan to the board to get it approved and overshoot and overperform than be in 4 quarterly meetings while we're explaining why we came very close, but underpinned. And this is not his nature, because he came from sales, but understands how in this new role in leading the organization, we want to be in a position where we're celebrating successes. And also, it's a really tough economic time out there, and so we want to make sure that we're moderating our spend to overperform. Internally, it really is about maturing the leadership and the broader bench, and then capital raises. And this is something I bring far more experience and have introduced him to external partners, folks at great law firms and investment banking firms and others who have successfully raised capital. So my experience has been remembering CEOs are people too. Brett, we're a CFO and now you're a CEO. You're still a person, and to try to bring your best self. Try to, and all that the business needs from a CFO. And there isn't a one size fits all model. Just adapt as a business adapts, and the needs of your leader adapts.
Sure. Brett, any perspective from you, especially in your switch from CFO to CEO?
Well, I'd say, looking back, I've worked for 3 CEOs. They've all been very different in how they manage, but they've all been have had intense integrity when it comes to the numbers. Just tell me the numbers. I'm not goal seeking. Just give me the numbers as they are, and then we'll figure out where we're going and what we need to do. And it was an example, and it's example to help. At times I felt like maybe I was the guardrail, so to speak, in the sense that, like, when I joined Press Ganey, it was about a $300 million company. And the first day that I was in the office, it was in September. So you're headed into year end. And Pat asked, what's the forecast for the balance of the year? And so I asked the person that runs the forecast, and I don't remember what the EBITDA number was that the guy gave me, but Pat said it's going to be 117.3. And you're thinking 117.3 million. How does he know it's going to be that precise? And then you're wondering, as a new CFO, is he really asking me to do something in the numbers to deliver that specific number? And what I came to learn is he wanted me to manage the business to get to that number, not through funny accounting, but through actually managing the business. So historically, the company had done all its budgeting on Excel, which is just a nightmare. In my prior company, we had used Cognos and TM1, and we pushed the budgeting out to department owners. So people owned and were embedded and engaged in their numbers. So we put those tool in Adaptive Insights the first year. And then it's just laying out, at least I found with the CEO, is to, here are the numbers, here are how they look. So in the case of Press Ganey, 90% of the business was annual recurring contracts. So you went into December and you knew pretty good what your run rate was going to be for the coming year based on contracts already in place, what's been sold and booked, net of cancellations going into the new year. And then so you'd present that, or Pat and I would work through that. Where are we going to end run rate at the end of the year? What do you think the sales, or what do we think the sales need to be next year? Or what do they need to be mathematically? Because to get to what our target was 7 to 9% organic growth. And then his goal was 11 to 13% EBITDA growth. So you lay out very clearly, here's how we're going to end the year. Here's what the new contracts that we've already signed up or will sign up before the end of the year. Here's how we'll enter next year. Let's layer on merit increases. Let's layer on any initiatives that aren't in this year's run rate numbers that we've committed to get to that revenue number and EBITDA. And you hope like hell it rolls up to 7 to 9% and 11 to 13%. And it typically didn't. So then you're going back and cajoling the departments to how do we take costs out, or how do we better spend money within your departments? And then it would really become a partnership.
because Pat would have in his mind, along with the COO, of things that we want to do this coming year that aren't in the numbers. So we would lay out those very clearly as a separate column, all the investments that we want to make. And then we would go through, the CEO and the COO would go through every position in the company above a certain dollar amount in terms of salary, not in terms of performance, but roles, and say, are these roles are they contributing to our success? Are they adding value, or do we need to invest in these roles? And typically what we find is there's some opportunity to redivert dollars. Sometimes it's reassigning people, and sometimes it was exiting people, but then to fund those initiatives. So when you would go to the board, or we would go to the board of directors with the budget, we have it very clearly laid out. Here's our run rate. Here's where we're going to end the year. Let's make sure we hit our numbers. Here's what we hope next year's sales will be. Here's our initiatives. This is what the numbers are going to be next year. And my role is if we weren't hitting our sales during the course of the year, or cancellations were coming in different and the forecast was rolling up different, was going back to each of the departments to say, how can you contribute to us delivering on what we need to deliver this year? Because Pat's philosophy at the board level is deliver your commitments. Don't come up short on that EBITDA number. And so my role at a board meeting was always very easy. I'd go in 10 minutes. Here were the results for the month. Here was the forecast. Here's the forecast for the balance of the year. And we never missed budget. So there was never really much of a discussion for me to have with board members other than you approved the budget in February or January, and we're going to deliver it. And we worked very hard. He and I, every month, the books would get closed. I said we'd have revenue by day 3, day 4. We'd have a consolidated EBITDA by day 7, day 8. We had a monthly financial review package that was kind of the inside baseball of how the business performed. And I'd go in and say, Pat, here's where we are. Here's how things came out. And he would be asking me, okay, so what do we need to do to deliver the budget?
Good. Thank you. Good.
Intense work environment, but very much partnership.
And maybe that's the roadmap to being a CEO in the future too.
We'll see.
Another aspect of this, of team focus, that I wanted to touch upon was everything has been internal really so far, but obviously you all work with external advisors and have kind of external teams to kind of execute on a lot of your major business priorities. Maybe Greg, you mentioned that you work with brokers and financial advisors, and I'm sure you have to work with lawyers as well, who admittedly can be very expensive. So curious how you select your kind of key outside advisors, and then how you kind of make sure that they act cost effectively, and so you're not overspending on your outside help.
Sure. And this is something we struggle with continuously on it. So I guess a couple of points. For us, it all comes down to domain expertise. We want to have the best experts in the industry, either on the banking side or the legal side, looking at our deals. So on the C-store and retail deals that we do and the gas station deals, we before we even do a deal, we want to know who we're going to work with. This goes back a number of years. We want to know who's the best in the space and at this specific deal. And so we're always looking for domain expertise. And part of that is just finding out who those people are. Every deal that's done in the public markets from an M&A perspective, be it at the wholesale level, midstream, oil and gas, or the downstream space, we have a list of who this potential sponsor was on the equity side, who the advisor was on the bank side, who did the financing, and who did the legal. And so we're constantly looking at that to see who's doing the most deals, who's got the most bandwidth and looking at things throughout the space. And we've got, and especially true on the legal side, I think, structuring a legal, an M&A deal is make or break on a deal. Like the deals that go bad are because there was bad structuring around it. We obviously have to execute on the operation side, but the upfront legal work is very important. We've got 14 in-house counsel lawyers in our group that are great in the day-to-day. And they handle basically 80% of the work we do. But they don't see everything that's going on out there. They're not sure all the trends. So we want someone that has landscape understanding, what's the newest trend on a purchase and sale agreement, what's the newest trend on a financing agreement. And so that's typically what goes outside counsel. We have one group that we work with, primarily a large law firm that does a lot of our financing work and our corporate work. But then, we go out for the expertise around environmental, around M&A, and around capital raising. So we're not afraid to use many different lawyers. But I think the biggest thing that it's important for us is before we even do a deal, we're trying to figure out who we're going to use. And I think you got to prepare. You got to know who to use. You don't want to land a deal and then be like, oh, I got to go find the bank, or I got to go find the lawyer. I mean, I think doing the work beforehand, understanding who's the expert in the space, be it who's the best bank financing for energy, who's the best M&A guy for the specific niche in energy, and you can all do that beforehand. Like, and we're constantly going out talking to brokers. Who are they using on the legal side? Who are they seeing interested in deals, and getting that list together so you know going into a deal. And you can do it in a small scale too. I mean, there's a lot of business brokers out there that work on smaller scale deals, and just networking with them and who they're using for accounting advisors, who they're using for tax advisors, who they're using for legal. So you know that your company's got a list beforehand. You're even looking at deals. And I think it also just helps. I mean, it's very time consuming, but it also helps just to know, so you have a network ready to talk about a deal. We do the same thing on the financing side with banks. We've got 19 banks in our bank group. We're constantly meeting with banks, although it's very time consuming, but we want to make sure that they're up to date on our financials, up to date what we're looking to do and grow. So when they're talking to other people, they bring us up as a potential buyer of something. Also, banks come in and out of the space constantly. I mean, we used to have 25 banks in our bank group. We've, through consolidation and through just exiting different areas, so you always want to be talking to banks too on the financing side. So you always have someone replacing, but just educating all advisors on the company itself so they have an understanding, so they're not just parachuted in and have to get up to speed is very important. On the cost side, we really we leverage our in-house counsel for about 80% of the work. So they're not wasting time with outside counsel. Like we want to make sure we get 80 or 90% there on a purchase and sale agreement or a financing with our in-house counsel. And then the last 10, 20%, we want outside counsel to review it, see what's market for a deal or not, tell us things that our inside counsel can't tell us, basically. So I think that's really where we try and save money. On the M&A side, we don't use investment bankers on the buy side. Our sort of opinion is if you need an investment banker to run a model for you or tell you what synergies are, you're in the wrong business, honestly. They're great to use on maybe larger deals for cover for the board, honestly. But if you're doing deals on the buy side and you're using investment bankers, you don't understand enough about the industry, honestly, in our opinion. Now, if it's a much larger deal and it's corporate changing, yeah, you probably need investment bankers for coverage on fairness opinions and things like that related to the board. But I think the smaller scale stuff, we are big believers in in-house. And we do use the banks for the financing piece of it because you need them there. But we really don't want to have banks telling us where we should be growing or what synergies we should be looking at. I think we want to do that all in-house, and that saves us a lot of money on the M&A side. And where we want to spend it also is candidly on the legal side, using outside counsel, getting the best counsel we can have to structure a purchase and sale agreement that's the tightest possible that's out there.
Great. Thank you very much. So Dave, I'm interested to get your perspective. Greg has the big public company aspect of it, very different business than Veracode. So curious about your experience in this and how it might differ from Greg's.
Yeah, so the majority of our probably outside counsel is M&A, tax, and legal, I would say. We are PE backed. So one of the things that I've found that's worked quite well is to basically be almost using the same advisors that our PE firm is using, which can sometimes create a little conflict that you got to keep an eye on. But the value or the problem that we're trying to stop from is you get your due diligence report or you get a tax opinion, and now you're ready to run with it, and then the PE firm is telling you, oh, that doesn't work for our partners, or that doesn't work at our level. And so you having somebody that basically has that viewpoint to kind of say, hey, you should probably check with your PE firm on this has been really helpful for us. Using the same teams and trying to use as much one-stop shop as possible has been another way to avoid you get this whole tax memo, you got everything that's all in line, and then you're going to do your tax return, and then your compliance folks are telling you, no, they didn't understand this and that, and now all of a sudden you're trying to put the two together and trying to figure out what's heads and what's tails. So that's been a big piece. And then the last on the cost side, I would say, is the biggest thing is, and sometimes you go into an M&A transaction, no one really knows how much it's going to cost or what it's going to be, but I would always push to get an estimate, and that at least you can manage against that estimate. Whether it goes over or above, it's a lot better than having a discussion. And sometimes it can even be 3 or 6 months after the deal is done, and you're being told, oh, by the way, we have this overrun and you have to pay, and there's nothing you can do about it then. Whereas at least if you had a number in your mind, you were planning on that. If it's going over, you can manage that while you're in the deal and address it accordingly.
Great. Thank you very much. So we want to save some time for questions here from the audience. So I have one more question that I want to run past the group. I think, Brett, I'm going to start with you, and anyone else who has any perspectives, feel free to weigh in. But we're preparing for this, one of the, talking about like challenges that CFOs have to deal with. And then many CFOs are now dealing with the technology sprawl challenge. And so, there's you drive down, I-90 in Boston, from the airport out to here, and you probably see like 10 billboards for like SaaS companies and different technology services, that I'm sure, many people within your organizations want to purchase. And so curious, how you manage kind of competing demands internally for different services, avoiding kind of duplicate services or trying to find, something that's cost effective and might work for everyone without having to pay for every service that's out there.
I think about the first time I was CFO, everything was on-prem. The general ledger system was on-prem. The HRIS system was on-prem. So the purchase of technology was a very deliberate process because it included the IT group to figure out how to host it and so forth. Things didn't surprise you so much. And, we're all seeing this world change very quickly. So the 5 years that I was at Press Ganey, there was, I think, a fairly organized process on as we go to more SaaS. If there's systems we're using that have proprietary data in them, what process have we put them through for security checks? But still, the spend was out in the departments, spread across the company. So, and as you dig into it, you find the number of seats that you have in this or licenses. It's not right sized for the organization, just all kinds of crazy stuff. So in that company, at Press Ganey, we moved every software tool, if it had proprietary data in it, not a reference database or something like that, but actually was a tool with data in it, it had to be expensed in the IT department in one chart of accounts. And then we assigned someone in the IT department to stay on top of all those tools, renewals, do we have the right licenses, do they have the right security, obviously, and so forth. But it really brought then transparency to how much we were spending on lots of stuff. And my year at Lumion before moving on to this new role is even more of a Wild West, where you see people expensing software tools on their expense reports or on the corporate credit card with the auto renews and so forth. I think there may be a vendor out here today that'll help with some of this. But the other thing that I think is kind of interesting, or that we're probably all struggling with, is I think about the IT person within the finance team at American Dental Partners, or even at Press Ganey. Their skill set was very much making sure the software ran and dealing with day-to-day issues of on-prem software. And I'm an advisor right now to coincidentally a software company itself, and it's about 50 million in revenue, and their infrastructure's behind where they are in terms of revenue. And so I was looking, she was sharing with me all of the tools they have, and the challenge now is integrating all of these different tools so that you don't have a lot of manual processes. And finding someone to manage all these different tools that are now used to make the business more efficient, I think is going to be a real challenge in finding that right person. Because I think about the two people that I had at prior employers, they probably wouldn't have the skill set to manage what needs to be done now, because it's very distributed in terms of decision making on why people are buying things and engaging them as to why do we need to spend money on this? Does it create value for the business? And I don't have a good answer for it other than first thing is to get it all in one place.
I was hoping you did.
I was praying. Get it in one
This is
place
the
so you
biggest
can
problem
see
I have.
how much you're
Yeah.
spending on it, because it's eye-opening once you get it all added up.
Before we go open the audience to open up to the audience, anyone else have any perspectives on that they want to share, or if you figured it out? Maybe.
A big key for us has just been getting it reported in a way, and looking at it in a frequent basis, because that gets everybody understanding what's there, and money is a good way to manage what tools are being used or not being used. So it's being able to measure it and report on it is probably a big first step.
Yeah, and the first step, this is a long time coming for us. We should have done it years ago, but we finally had the right chief technology officer to give us a roadmap of the future too, so that we make sure anything we're onboarding on the software side is going to fit into that roadmap instead of just bolting everything together. Because now we have this, amalgamation of software that doesn't quite fit the roadmap. So now we're on the journey we're in right now, is we're getting rid of some software, some redundant stuff, and we're sort of cleaning it up. But having that roadmap for us has been a huge changer for us. Looking out 5 years, 10 years, and where you want to be from a software standpoint.
we're not as sophisticated in the roadmap, but we've taken a pedestrian step forward or two, not only in the aggregation of the data, but every new tool that is brought in, it can't live in isolation. So how is it going to connect and work with other things?
Yeah.
So and we don't have all the talent inside. We've found some partners to help us. So on Salesforce, we use a quote tool, CPQ. It's all got to work together. The feeds that come into NetSuite, it's all going to work together because we found ourselves with a bunch of really cool tools that lived in isolation chambers rather than kind of CrossFit in support of the business.
Great, thank you. So with the remaining time, we'll open it up to the audience to see if there's any questions for any of the panelists.
We've got a mic back here for Q&A. If you wouldn't mind waiting to ask, I'll bring it or ask.
I think we have one question up front here. Yeah, go ahead.
We can repeat it.
So from a cross-functional perspective, I'm pretty interested to understand from an incentive standpoint, how are you incentivizing your employees to align with the cross-functional nature of the jobs that you're asking them to do? And have you found that, like, what are the best practices that you found that have been successful?
We're not yet successful, but I'll share our recipe. And the recipe that we're working on is we have bonus targets for different roles. And so the OKRs of the business, the objectives of the business is part of the planning process are getting brought down to all of the functional areas. And so if we can't be successful, if the deal team isn't working properly with the sales team, that's an OKR. And we try and keep it to 3 is better than 5, but not more than 5. So it becomes, rather than incremental spiffs, to think of it from a sales perspective, which actually we tried, and we found the dev team weren't as motivated as the sales team were with those kinds of tools. It's their job. They do it really well. They have too much to do. Tell us what you need us to focus on. And so it's a way of measuring earning on the bonus. And as I said, it's a recipe that doesn't quite taste perfectly yet, but that's the path we're on.
Yeah, I would say for us, we're not doing it so great where we currently are. It's because many of the objectives are very like broad and like, top line or profitability of the entire corporation. Where I've seen it work probably the best, and it wasn't perfect, is when the executive team got together and created a list of no more than like maybe 10, 15 KPIs that got us to those major results, and broke it down where it could apply to the product management team, to different parts of the organization in R&D, or as well as customer success. And when that was possible, that's when you broke that down and each person could directly influence those metrics, and they were successful, that led to the higher success. That's usually what I've seen work the best in my past.
I guess, but two of my prior employers, the incentive structure, the bonus structure was 50-50, half on company performance and half on personal objectives. And then the question about cross-functional success is going through that as a team, going through the process, and not just staying focused on finance, going through what are the things that we need to do as a team the coming year to improve the operations of the business. And invariably, there'll be an initiative that's cross-functional outside of the department. And so there would be someone within the department that would lead that. And their bonus, 50% of their bonus is tied to their personal objectives for the year, which some of them would be cross-functional across the organization or not. And, I think about the times over the years, lessons learned where you get to the end of the year and you're going through, okay, did you get these projects done? And well, I didn't get it done because the person in the legal department was tied up for the balance of the year and they didn't have time to help me with this. And it's like, no, we need transparency on this, and we need to revisit this probably 3 times a year is what I would do, is every 4 months, sit through those the matrix that we all agreed to as to the projects that we're going to get done and where are we, and is whoever outside of the department needs to be involved, are they ready to get this done by the date that you say you're going to get it done?
Yeah, we try and focus on incentive structure being somewhat discretionary and rewarding people through that who have done. But I think the one thing that goes a long way for people internally, especially in a sort of more remote work environment where 3 days a week in the office, is just employee recognition through our own internal resources. We have an app that all of our company employees communicate through. So we recognize deal heroes, basically someone who's on a deal who worked across, he worked with accounting or he worked with treasury to get this deal done. We try and recognize those people monthly. And I think that goes a long way. And just for people to network too, as people are more remote, it's tougher. So people can see, oh, Jill worked on that deal. She really helped it out. I'm going to ask her again. And we look at this deal to help me on this deal. That sort of helps. So that's a small thing that has helped us.
Okay, great. I think we have time for one more question.
So for your finance team members to lead cross-functional efforts, what's your advice as a CFO? You enable your finance team to lead the cross-functional efforts versus you needs to step in so they can reach out to you for support when needed before things go to the other direction. Thank you. Did I make my question clear?
Yeah.
You know,
Thank
this specifically to this expired contract example that I gave you, I immediately called the general counsel, who then called the head of contracts, and the salesperson, who was also unaware, then calls in the person that runs sales ops. At the end of the day, the problem didn't get solved by the general counsel, the head of sales, or myself. It was person in sales ops, person in contracts, and the person in billing and collections within Preskini that solved the problem, or at least got it close to being solved. So it's getting the leadership in each of those areas where you've got a cross-functional issue, get them to agree that it is an issue that needs to get resolved, and then who in your team can then work together to resolve the problem.
And I would say, I mean, it requires putting people on your team, especially the ones reporting, I would say, directly to you, especially in a small organization like the size of ours, where they have that curiosity to want to move to the other parts of the organization. And, you know, finance people sometimes just want to roll up their sleeves, put their green visor on, and do their debits and credits. And that's not going to help on the cross-functional side. So you need to have folks that have that curiosity and want to go to the other parts of the business and work with them.
The other thing that I'd add is organizationally, I think the CFO has to have the back of the leaders that they're asking to work on these cross-functional teams. And so if the muscle memory organizationally is, I got a problem, I'm going to the CFO, I'm not talking to the project lead, our instincts may be, I can help you out. But in fact, we could be unintentionally undermining the member of the finance team who's responsible for the project. So I think we have to, when the doctor hits that point in our knee and the foot kicks out, we can't do that reflex. I think what we need to do is step back and say, have you talked to Heather about it? She's leading it. And then if there are backdoor conversations where it could be brainstorming, and I say that because it's a fault of mine that I'm working on. So I'm glad for the question.
Okay.
So I want to take a minute to thank you for coming to this particular session this morning. Fantastic conversation. As you go to lunch is next, right? We encourage you to carry on these conversations at the tables that you're eating. Of course, if you see any of our speakers, you can bend their ear as well. So real quickly, just a real quick round of appreciation for Craig.